When I'm trying to avoid paying taxes legally, I hear a lot of stuff online about the traditional IRA and the Roth IRA, but those are not the best account. Very few people are aware of this account, and the ones who are not utilizing it to their full potential. This account wasn't even designed to be an investment account, but it happens to be the best account. I'm talking hundreds of thousands of dollars in tax savings. So grab a drink, take a seat, let's talk about it. What's up, y'all? It's Brian. I'm talking about the HSA, but more importantly, the best way to utilize the HSA to save hundreds of thousands of dollars in taxes. For those who are not already familiar, the HSA stands for Health Savings Account. And the way most people utilize this account is they contribute money throughout the year, and then as they have medical expenses, they spend that money. It's in and out. But you can invest that money in the stock market. For me, I can invest my HSA money through Charles Schwab. And the reason this is so powerful is because the HSA is the only triple tax advantage account. So if I compare it to a traditional, like a regular brokerage account, like Robinhood is zero tax advantage. When I make an income, I have to pay taxes on that income, and then I put it into the account. And as it grows, if I make any dividends, I have to pay taxes on the dividends. If I sell one stock to buy another, if that had any gains, I have to pay taxes on that. And then when I'm ready to use that money, if I sell a stock that had gains and I want to pull the cash from the account, I got to pay taxes on gains there as well. So a traditional IRA and a Roth IRA, they're both really good, but they're only double tax advantage. With a traditional IRA, the money that I make gets shielded from income taxes when I put it in. So that's one. As it grows, I don't have to pay any taxes on dividends or selling and buying stocks. As long as it remains in the account, I don't have to pay any taxes. That's two. However, but when I withdraw it, I have to pay income tax. With the Roth, I don't have to pay taxes when I withdraw it. So that's one. As it grows, I don't have to pay any taxes. That's two. But when I make that income initially and I want to put it in, I still have to pay income tax. This is where the HSA, it combines the best qualities of both the traditional and the Roth. I get shielded at all three stages, and this adds up to hundreds of thousands of dollars over the course of my life. I put it in, it's tax savings, it grows tax savings, but then when I withdraw it, as long as I withdraw it for healthcare costs, then I don't have to pay any taxes on the withdrawal. And that's a red flag to a lot of people. Like, oh, it only works if I use it for healthcare costs. But you would be surprised, especially in retirement, the healthcare costs are a huge part of your spending. When I pull up the average healthcare cost per year, clearly the costs go up dramatically as I get older and older. The only exception being when I'm under 5, because I have some additional costs associated with birth. But in general, $3,000 per year between 18 and 44, $6,500 per year when I'm between 45 and 64, and then over 10 grand on average per year when I hit 65. So yeah, I'm spending a lot of money in retirement on healthcare. So why not save specifically for that purpose? If I scroll down a bit, I can see the expected cumulative cost per age group. So when I'm 65 years old and above, I'm expecting to pay on average $170K in healthcare expenses. So I need to have that chunk of money saved. Now, one of the great things about the HSA is I can reimburse myself for previous healthcare spending. So from 45 to 64, I spent $130K. From 18 to 44, I spent $80K. That's over 200 grand that I can start reimbursing myself when I'm 65, as long as I have a record that I spent money on those medical expenses. So let's say I hit 65 and I want to go ahead and withdraw that 200K. I can withdraw 50 grand each year for 4 years and pay zero taxes on it. And then with the remaining 170, I can pull that out as I need it. So yes, there is going to be a lot of healthcare expenses when I'm older. Now, what happens if I save too much? If I put too much in the HSA, let's say I end up with $1 million in my HSA and I don't have that much in healthcare costs. Did I screw up? Did I waste all that money? Once I turn 65, I can pull money out of my HSA for any reason. It does not have to be a medical cost, but I do not get the triple tax advantage. If I pull it out for another reason, I still have to pay income tax, which means in the worst case scenario, The HSA is an extension of your traditional IRA. That is exactly how a traditional IRA works. You pay income tax when you withdraw it, but you still got the double tax advantage along the way. The traditional IRA is an incredibly powerful account. There's a reason the government cuts us off. So if I pull up the traditional IRA requirements, so I'm only allowed in 2025 to put $7,000 in a traditional IRA. And then the government cuts me off because they don't want me saving all that money on taxes. And then they cut me off if I make too much money. If I make more than $89,000 in a year, they don't let me put anything in the traditional IRA because the more money you make, the more money you save on taxes. So they want to cut you off. So in the worst case scenario, the HSA just makes your traditional IRA even bigger. And then in the best case scenario, you get to save even more taxes on healthcare costs. How much money am I talking? Of course, I had to do the math. Let's look at how much money I'm expecting to save in taxes in the different situations. In 2025, the maximum that I can put into an HSA is $4,300. So let's go with that. Let's assume I'm going with the maximum. Let's assume that our income is $65K. That puts us in the 22% tax bracket. That means when I put $4,300 into my HSA, it doesn't feel like I'm putting $4,300 because of the initial tax savings. It only feels like I'm putting $3,354. It's like investing on a discount. So if I was only able to invest $3,354 over 35 years, if I'm starting at 30 and I'm pulling it out at 65, right? That chunk that I invest at 30 is going to grow for 35 years. If I get average stock market returns, that would grow to $94,000 on average, which is pretty good. But since I was able to invest $4,300, that is expected to grow over 35 years at average returns to about $120,000. So right off the bat, I'm getting about $26,000, $27,000 more because of the initial tax savings. That's already a 28% increase in my money. Then as that money grows, I'm not having to pay any taxes on dividends. So if I'm investing in the S&P 500, the dividend's pretty small. It's 1.2% right now. That's going to add up though over 35 years to about $2,000 in tax savings. Then at the end of the day, when I pull it out for medical expenses, I don't have to pay any taxes. Let's say we end up paying an effective tax rate of about 15% on $120,000. That's about $20K right there. So by the time I pull it out at 65, I've saved $43,000 in taxes. And that's going to repeat every single year. Now that might be on the upper end of things, but even if I was able to save just half of that, let's say I was able to save $20K in taxes, after 10 years, that's $200,000 in tax savings. That's compared to a brokerage account. If I invested in a brokerage account versus an HSA, if I compare it to the traditional IRA or the Roth IRA, it's not quite as good, but it still beats both of those. It beats the traditional IRA by $12,000 in that situation, and it beats the Roth IRA by $26,500 in that situation. Having $120K in retirement for medical expenses, it does seem a little bit extreme, but we have to take into account inflation and the rising cost of healthcare. If I go back to the resource from earlier, the cumulative cost of healthcare on average over somebody's life in 2016 is $414,000. But in 35 years from now, if there's average inflation, about 3% per year, $400,000 today is going to be about $1 million in total spending in 35 years. And healthcare costs may rise faster than inflation. Over the previous 2 decades, this estimate shows that healthcare costs have increased twice as fast as inflation. So here it sums it up at 0% faster than inflation is $400,000. If it increases just 1% faster than inflation, then that's $710,000 in today's dollars. And that's not accounting for inflation 35 years from now. And it only gets worse and worse. If healthcare costs increase 5% faster than inflation, then we're looking at $7.7 million. I think it's prudent to assume I'm going to have a lot of healthcare costs in retirement. And even if I save more than what I need, the worst case scenario is it's just an extension of my traditional IRA, which the government wants to cut me off anyway from the traditional IRA. So this is an incredibly powerful tax savings account. Now, I don't have to go all in. I don't have to invest 100% of what I put into the HSA. I could invest 1,000 or 2,000 and then use the rest of it every year for my healthcare expenses as I go. If I were to invest just $1,000 into the HSA for 35 years, $1,000 would grow to $28K. That way I would have $28K every year in retirement for healthcare costs. Just getting average investment returns with the S&P 500 yields incredible results. But what if I can get better results than the S&P 500? See you in this video right here. Cheers.